Hello, this is Mike Swanson of WallStreetWindow.com. I got a very special guest with me today. Speaking with David Skarica, and we're actually doing a live video. It's almost noon, Wednesday, April the 25th, and we've seen some wild stock market gyrations over the past couple weeks. Last week, there's a day in which the NASDAQ went up over 100 points. Netflix reported earnings, and people got very excited about that. But over the past couple of days, the market's been weaker. It seems like even if earnings are good, stocks just gap up and sell the news, and they're bad. They really tumble. But yesterday, Google, it fell on earnings. Even they increased their expenses. Today, Sirius Radio is down on earnings, even though it gapped up. And so is Twitter. It gapped up on earnings this morning and fell. But yesterday, 3M got smashed. Caterpillar had a gap up and dumped, and it had a very bad day for the Dow. But today, so far, I'm going to pull up a chart and show that to people. But so far today, you know, the S&P 500, it's fallen down to the 200-day moving average, but it's kind of bounced or tried to. So do you think this is a good time to buy? You were holding the 200-day moving average. People are excited on Twitter.
Well, look, like the only real positive scenario here, and it would only just buy you a couple months if the lows hold here, is if you go to my website, addictedtoprofits.net, I did this whole series called Is the Past Prelude? And I talked about past bear markets and how the market's trading. And in 29 and 87, there was a situation similar to this where we saw the market kind of like a 8, 9, 10% pullback in the spring. And then in about this April, May period, the market bottomed and then blew off into the summer. So that's essentially your bullish scenario. And even under that scenario, like maybe the S&P would take off and go to 3,000 into the summer and blow off, or 3,100, but it would still crash in the fall. So if you're talking like what that scenario would do is you'd probably see a peak in about August. If that were to happen, you'd buy yourself another 3 or 4 months, really. So and that see that in your chart there, look at that move that happened, say in 3M, and you can see the S&P itself. That move really from like August, September to like the end of the year. Go back to the S&P just for a second if you can.
Okay.
And it's just the same thing, right? But you can see, okay, first of all, actually, then we'll go back to 3M in a second because I'll talk about why that's important. But anyhow, that move, that to me looks like a classic parabolic blow-off. So the question is this just a pause of the blow-off like happened in the spring of 87 or 29? Or is this like the Nikkei 1990 where basically the blow-off peaks in December, January, and you just start falling all year? So that's the real question. I think the problem is now if you go to 3M, this is part of the problem. The 3M is one of the leadership stocks, right? This was kind of like, I call it like a buyback baby, right? This is a stock that was buying back tons of, it's kind of funny because I actually have 3M up on my own screen now too, without even you doing it. But what I'm doing right now is I'm going to show you something interesting about 3M, and I'm going to show you this stuff with a couple other companies. That 3M was just all financial engineering. What that means is they were essentially using debt to buy back stock and keep their dividends high, etc. Like 3M at the end of 2015 had. Now I'm going to cut off my screen here. Show this screen here. 1 second. I'm going to show you my screen. Okay, so here's 3M right here, and you can see at the end of 2015 they had 8.7 billion in long-term debt, and that increased to 12 billion at the end of last year. When you do the math on that, that is an increase of 3.3 billion. That is absolutely gigantic. That is an increase of like 35% in 3 years for a large cap company. And then if you look at their income statement, they had like 30 billion in revenues, and last year they had 31.6 billion. So they've only had like 5% growth in that same 3 years of revenues. And actually, if you go back to 2014, the revenues went down in 2014, 2015 because of the dollar going up and 3M being a multinational and getting a lot of their revenues from overseas. So essentially, they have the same they have less revenues than 2014, or about the same revenues. And if we go look again at the price chart of 3M, I'm going to get a weekly chart and go out a few years.
Yeah, I just did that on mine going back to 2012. It's even, you can really see the gap down then.
Well, like look at 2014, where I say they had about the same revenues, right? Well, the stock was $120 a share at the October low, and through much of the year, 120, 130. Well, the stock essentially doubled to the beginning of this year in less than a 4-year period, with the revenues not going up at all. So that is completely unsustainable. And if we again could look at the cash flow of 3M, where we can see how much stock, you can see that they actually had even slowed it down a bit. But what they've been doing is just in 2015, they bought back over they bought back $4.6 billion worth of stock. They bought back, $2.9 billion in 2016, and last year they bought back $1.3 billion. Last year, it looks like they actually increased the dividend more than they did buybacks. But what you can see with these net borrowings in these 3 years, again, their net borrowings come to 4.4. It's just not all of them are just long-term borrowings, and some of the rollover debt. But they borrow $6 billion, right? And then they use that to buy back about $9 billion worth of shares. So this is not sustainable. Anyone who knows basic mathematics knows that you cannot keep borrowing money, buying back stock, not growing your top line, and the stock keep doubling and tripling. And then if we go look at it again, 3M, you can see just the last thing here, Mike. Again, the income statement, $31 billion, right? And if we go look at the market cap of 3M, $117 billion. This is a large cap, company. They make, those stick-it things you put on your fridge. This is not some growth company. As we can see, they have no revenue growth in 4 years, trading at 25 times earnings. Earnings are inflated by the buybacks, and trading at close to 4 times sales. And we're over 4 times sales at the top. So the thing is about these kind of stocks, Mike, and if we look at McDonald's, you look at other companies like this, people will say, oh, you guys have been perma-bears. Well, this is why we've been bearish, because these companies like McDonald's, 122 billion market cap, 22 billion in revenues, 5 times revenues. Again, McDonald's, 27 billion to 22 billion in terms of revenue. And yet the stock of McDonald's, just to do one more, I could do a million examples. We'll just keep it at those 2. The stock of McDonald's, same thing, gone from just over $80 a share to as high as over 175. More than a double since 2014. How sustainable is this? That these companies are seeing declining revenues or flat revenues, and their stocks are doubling and tripling due to buybacks and stocks. And last thing, let's just go look at McDonald's cash flow, and you can see the net borrowings here. They actually went on a total spending spree here, or borrowing spree in 2015, borrowed almost $10 billion. And it actually looks like McDonald's isn't doing a huge buyback of stock, but they're using, and their dividends actually been rather flat. But again, I think McDonald's is doing a buyback though, so I'll have to look at that. But you can just see a huge kind of borrowing spree here from, here. And you can argue, well, how has McDonald's been able to keep their dividend? Well, because their revenues are gone down 20%, and their dividends have stayed relatively flat. Well, McDonald's has been able to keep their dividend up by essentially, borrowing money to make up for that loss in revenue.
Yeah, you still there?
Yeah, I'm still here. Yeah.
Oh, okay, I thought I lost you for a second. Yeah, well, what would you think though of the argument that was made last year? In the first quarter by Warren Buffett, that, okay, you're looking at this balance sheet of McDonald's and 3M, and these are 2 stocks, but really no one needs to do that to make money. You don't need to do any research. You don't need an investment advisor. You don't need to look at individual stocks, much less this balance sheet information. All you need to do is put all your money in an ETF like SPY, and it'll just go up forever.
Well, that's not going to happen at some point. It's worked until it. There's this old saying that it doesn't matter till it does, right? And like, again, just quickly, Mike, just McDonald's again, about $15 billion of long-term debt in 2014, almost 30 billion now, a doubling in the long-term debt. And this is like a large cap company, right? This is not, just some little company taking on a little amount of debt to try to grow their bottom line or something, right? So anyhow, that would be my comment, is that, look, we look at the price of sales, we look at these things, and the one thing of the whole thing about that whole buy and hold, I guess you could call them the equity huddlers, right? And just holding forever and never selling, is there have been times in history, and again, I'm going to get a Dow chart so we can show this. Actually, I'll get an S&P chart because it shows it actually even a little better. There have been times in history where you don't want to do that. Like if you go back, I'm going to go back 20 years so we can see the last two bear markets. If you go back 20 years, you can see if you had bought in 2000, you didn't make your money back till really 2014. Because, once you got back to even in 2007, 2008, the market talked again. So, and adjusted for inflation, I think you just got it back in the last year or two. So there were certain price points when, obviously 1929, the market didn't come back for 25 years. In 1966, same thing. I don't think it came back in 66 for almost 30 years, adjusted for inflation. So there are certain time points where you don't want to buy. Now, the problem is, because our own lives are not that long, right? You really start making income as an adult, say in your mid-20s, and maybe not even start investing to say your 30s, and then you retire in your 60s or 70s. So your own time frame is 30 or 40 years. So you think that 5 years is a long period of time. And yeah, 5 years ago in 2013, if you had bought, the market has doubled. So you'd be pretty happy with that. So I would just say that there's certain price points where you don't want to buy. And right now is probably, essentially one of them. I would just be very, very patient. And this, just looking at this, giving this S&P an eye test, you would just see this and just say, hey, you know what? If you are really bullish, it at least needs a pause, like 2014, 2015. And it's impossible. Like, I'm going to go back to, 1980 to really show you, you're just going to see it's impossible for the market to keep going up like this without like a breather. It's like if you run a marathon, right? You got to stop and, and sleep for a night, The markets are the same way. And you can see that, when they went straight up in the 80s, you had the 87 crash here. And then you had the 90 bear market. And then even after they went up all through the 90s, you had that 2002 bear market. And then again here. So you need some kind of breather. I would say that you kind of circle this here, and maybe the old resistance becomes support, like 1600 on the S&P. Even if you were a bull, I would think that 1600 to 1800 would be kind of an area where you would think that a bear market could last. Now, I am much more bearish than that because of the financial. What I just showed you, 3M and McDonald's are kind of my poster boys. There's plenty of other companies doing the same thing, but the increase of valuation, the expansion in multiples in terms of price to sales, and the financial engineering and the taking on of corporate debt, that is why I'm so bearish, because I think that this is kind of a once-in-a-generation type bubble that they've created. Shockingly, even bigger than 2007.
Yeah, the thing that's really troubling about this debt situation is, we're seeing corporate bonds go down this year. I mean, treasury bonds have gone down a little bit, but corporate bonds have been in a big bull market since 2012. And now they're all trading below, this is CORP, a corporate bond ETF. It's below the 200-day moving average, the 150-day moving average, and the 50. And it bounced a little bit in March at the same time that we had the last stock market bounce. But now it's at a new low for the year just within the last couple of days. Now, that may not immediately mean anything tomorrow, but McDonald's and 3M, and those are just two examples that you have shown here, when we could sit here for hours on end going through more of them. But when this ETF goes down, what that means is it costs more money for companies like 3M and McDonald's and all of corporate America, for that matter, to issue bonds and to use the debt market. So their expenses will slowly go up. And for the past couple of years, they've been using so much of this debt to do corporate buybacks. And if these bonds continue to decline like this, that's something that will eventually slow down or come to an end and take a major element of buying away from the stock market.
Well, what I have here is the A-rated corporate bond debt. And what you can see is this has actually been a downtrend since the early 80s. I just got this going back to 1990, so we can see what's happened in the last 6 years a little more visibly. And what you can see is even during the cheap debt bubble of the 2000s, the real estate bubble, you know, corporate AAA or A-rated corporate debt was yielding 5 to 6%. And people were going into mortgage-backed securities because, you know, treasuries weren't yielding anything, and these were only yielding 5-6%. Historically, these are yielding, you know, like 7-8%. Well, now they've been yielding 3-4%. That's why those companies have gone on that borrowing spree, right? And see, the analogy I'm making is, now, first of all, graphically, I think we got a huge secular low going on here in the last 6 years. That we're, once we break, say, about 450, 460 on the A-rated corporate debt, it's going to go much higher. And then the second part of this, and this is where I think it gets really dangerous, is what was the problem during this whole mortgage-backed security boom in the 2000s? Well, the problem was the stuff was really junk. It was crap, but it was rated A-rated or AA or AAA rated, and that's why it crashed, right? Well, the problem here is this stuff is, in my opinion, I just showed you what 3M and McDonald's did to their balance sheets. Like McDonald's, you know, has doubled their debt just since 2014. I would almost think that with revenues down 20%, I would almost think that you're getting to the point where it's junk. It's not an A-rated company anymore, even though everyone knows McDonald's and it's a Dow component. So I think that's the mispricing that you're talking about, the Corp ETF. I'll put that up as well. The mispricing is just like the teaser rates on mortgages sucked everyone in at an artificially low rate, and it ended up being junk. The low rates on these corporate bonds have sucked these companies into borrowing. Now, granted, they don't have the leverage. Remember, all those mortgage-backed securities were leveraged 10 to 1 or whatever, or 20 to 1. They don't have the leverage. That's true. If you just own a corporate bond, you own a corporate bond. But the problem is they're just, because of what they've done to their balance sheets. And remember, I talked about the yield at 450. Well, you can see that this corp that you talk about, it yields 3.14. So we're still a little whiles away from that. And if the historical average in corporate bonds is like 7%, we're still going to double, in yield to get back to that, which will destroy the balance sheets of a lot of these companies if that's the case. So anyhow, what I'm trying to say, long story short, is I do think that the subprime now is in the corporate bond market. Just like all the borrowing went around in housing and mortgage-backed securities from, say, 2000 to 2006, now all that borrowing in the last 7-8 years has happened in the corporate bond market, and it's really been escalated in the last 5 or 6 years. And if you go look, I go back to that chart of Corp, historically, I'm going to get a longer-term chart of this. I might have to get, well, this only goes back to 2011. Here's another one. LQD, you can see that other than the 2008 crash, these things have been very steadily upwards. And again, it's kind of like housing. What did people say in the 2000s? Housing never goes down, right? Because it hadn't gone down in 20, 30, 40 years. Well, it's the same thing with the corporate bond market. It's been so steady and so stable that people think it never goes down.
Yeah, well, it's been in a bull market since the early 1980s, and that's what everyone's used to, is this going up. And also being a safe haven for your portfolio, because, you know, in the last bear market cycles, all of them since the 1970s, when the stock market's gone down, bonds have gone up. So there's an entire generation of investment advisors that put people, you know, in 50% bonds, 50% stocks, you know, roughly maybe 30% bonds, 70% stocks if they want to be more aggressive. So everyone is invested in this in the United States. And if you try to tell them to do anything different, it's very difficult to get them to listen.
Well, then, because if you look back since 1982, when the stock market bottomed, the bond market bottomed in 81, essentially, even though there were different correlations, like in the 87 crash, bonds fell in price and stocks fell in price together. But in the 2000 and 2008 crashes, bonds rose and stocks fell. But essentially what's happened in the last 35 years, they've each risen in price. You know, like the yield on the 10-year bond's gone from 15% to under 2% at its lows. And then, you know, the Dow has gone from 700, under 800 to as high as, you know, I think it was over 26,000. So they've essentially like been correlated with each other. So in the long term, it's just like the real reason people are making that asset allocation is that, remember, stocks did nothing in the 70s and fell adjusted for inflation, and bonds tanked in the 70s. So people have just done that allocation because, like you said, it's lasted for so long. And you know, I've got the treasury yield here. And again, what we can see, kind of like the corporate bond yield, it looks like we're putting us a massive bottom. And Mike, here's something I find really, really interesting is that, you know, people have kind of ignored the fiscal side of thing because these governments have been running deficits for so long, and rates, let's face it, have essentially been low, you know, for most of the last, like you look at this bond, other than a little period of early 2000, in the last 20 years, going back to 1998, the yield on the 10-year bond of 6%, which, by the way, is about the historical average, has been below that, right? So we've had rates so low for so long, people don't really think it matters. But what's interesting is I really think, forget all the stuff in the market for a second, the turning point was actually after they passed the tax cut, when they passed the budget in late January, and basically said they don't care about the deficit. The deficit is going to be near $1 trillion next year. That was a real turning point. We saw the bonds begin to rise in price. We see the stock market beginning to sell off. And it's almost like the market is starting to feel that them blowing up the deficit going to flood all, flood the market with all this government debt, and saying we don't care about deficits was almost like so reckless, even for the government, that it almost was a turning point for interest rates in the stock market.
Yeah, in fact, the Dow peaked out a day or two after that news item. And after the Dow dropped, I went back and looked. You know, there's a big focus on Trump and trade and China, and it started, but that news story actually started with Trump's meeting with these steel executives where he announced steel tariffs. And that meeting actually took place after the Dow had fallen initially off the high about 10%. And over the next couple of weeks, that's all the media was talking about, Trump and steel and tariffs, and then China and tariffs. But in reality, the drop happened before all that. And almost immediately after the revelation that the deficits were going to explode or start to, much quicker than anyone ever expected. So that seems to be the real driver of these interest rate rises and the bonds falling in price. Well, that's really impacting the stock market.
I think, too, the national debt, just since the late 90s, has gone up like quadrupled, right? So if you just do some basic math, well, in the mid-90s, you had interest rates at 6%. If you quadruple about 1.5%, a quarter interest rate gives you about the same interest payment. So if you're saying I'm just going to make the number easy, right? If you have $1 billion in debt and you're paying, let's just make it really easy. You got $1 in debt and you're paying 6%, you're paying 6 cents, right? If you go to $4 in debt, to pay the 6 cents, that interest rate has to be 1.5% instead of 6 cents. Sorry, say 6%. Well, now if the interest rates say we're to have some kind of spike and go to 6%, it would mean that instead of paying, that 6 cents on the debt, right, you're going to be paying 24 cents. So you're going to be paying 4 times the interest payment, and it's going to eat up a bigger portion of the budget. And then at some point, you might have to start cutting military spending or cutting unfunded liabilities like Social Security or Medicare or Medicaid, right? So that is where the issue lies. And by the way, the same goes with these companies. These companies have issued so much debt that if their rates are larger and they have to roll over the debt at higher rates, they might have to cut research and development. McDonald's might have to shut down stores and fire people, right? That's what happens when your debt loads are too big. I think what's going to end up happening is when the market tanks and and corporate interest rates are higher and these companies can't really afford to roll over the debt, two things are going to happen. I do think the Federal Reserve will come in and buy corporate debt. And the second thing, though, I think they'll issue equity to raise money to basically pay down that debt because they don't want to keep issuing it. But here's the disaster with that. Again, basic math. All these stocks are going to be tanking when that happens. So all of a sudden, McDonald's goes from 150 to 50. They're issuing stock at 50. 3M is issuing stock, same thing, maybe at $100, $80, wherever it is. And what's ironic about that is all the stock these companies have taken off the market in terms of buybacks, then flood back into the market when essentially they'll probably have to issue some kind of equity to pay down their debt. So like it would almost be like, this is all for naught, as they say, right? So I think that's going to be the biggest disaster. And by the way, if you don't think this can happen, here's the perfect example. Gold stocks didn't really do stock buybacks, but what gold stocks did was that because it's very difficult to expand your gold production as a large cap company, there's a finite amount of gold in the world. So when gold went up, their way of doing increasing profits was they used debt to go on takeover sprees. Barrick, Newmont, they all took over a whole bunch of companies to add to the ounces produced. Well, what Barrick's been doing since gold tanked to become a leaner company, they're doing two things. They're getting rid of the unprofitable and higher cost properties, so they're becoming a smaller company, and they're paying down their corporate debt. So if you don't think this can happen, just think, oh, this is going to go on forever. There is a class example of an industry that did bust, and one of the things that happened once it did bust is they started to pay down their debt, right? So, and I just want to quickly show you this. I think you'll probably see it on their balance sheet. Yeah, long-term debt in Barrick has gone from 9.8 billion in 2015 to 6.3 billion last year. So they unlike so basically it's the exact opposite of 3M, right? Where 3M has increased their debt by 35%, Barrick has decreased their debt by approximately 35% in the last 3 years.
Well, and that's it's kind of funny. People think the people running the corporations are real geniuses, but these gold companies did all this stuff towards at the wrong time, and then they have to scramble to pay their debts off when gold is falling in price. And corporate America generally does the same thing when times are good. When the stock market's rising, that's when they want to do the share buybacks and they grow in debt. Then when stuff starts to turn down, they kind of get trapped.
Well, I just think that humans, we're all influenced by, we're creatures of psychology, you can say. So, like, what's interesting about the buybacks is in 1987, after the crash, companies increased buybacks because a crash happened. They thought their stock was cheap. But in 1987, companies did not have access to this cheap money, right? So they were more diligent in their buybacks. If they're going to buy back their stock, it's because it's fallen, it's cheap. Well, now it's like money is so cheap, they're just borrowing and buy back stock. And it just shows you when you have this kind of cheap money prevalent, and it's been going on for a long time, even the CEOs, who are probably mostly Harvard and Yale educated, they do the same dumb things that the regular investor could do, right? So it just shows you, like you just said, yeah, they're not doing anything that's any different as well. And by the way, here's another example. The long-term debt for Newmont has gone from 6.4 billion to 4 billion in the last 4 or 5 years as well. So we're seeing these big, these gold stocks are actually getting less leveraged, as the rest of the market has gotten leveraged, because the difference with them was their peak was in 2011, and they've had 6 years of hard times, 6-7 years of hard times, and they're deleveraging. And you're going to see the same thing with these with major corporations once this debt bubble bursts.
Well, it seems like we're seeing a mega shift with the bonds and the debt situation. Even today, as we're speaking, You know, it looked 15 minutes, 30 minutes ago as we started this video, maybe the market could go green. I think the NASDAQ was green, and now at the moment it's back down. But as that move is faded, who knows what it'll do on the close or tomorrow. But as we've been talking, I noticed on your Yahoo Finance there that some of the gold stocks are actually green and they were red today. So do you think the gold stocks are starting some sort of shift this year to benefit from all these problems?
I think okay, I'll show some charts in a second here to do this. I think the real key element for the gold stocks, we're talking about interest rates. Now, even though I think that the 10-year treasury may be seeing a long-term secular bottom in yield, I do think you could have some rallies, especially when the Fed begins to cut rates. Now, remember, too, cutting rates on the short end does not necessarily mean that interest rates are going to go back to 1.5% on the 10-year. If you go look at what happened in Western Europe during kind of the pig crisis of 2010 to 2012, the European Central Bank cut rates to 1%, but places like Italy and Spain and Greece and in these places, in Ireland, saw interest rates spike. In the case of like Greece and Ireland, into the double digits. So that doesn't necessarily mean that long-term rates are going to go down, but short-term rates will at least mean that you're getting less on short-term deposits or short-term bonds. And in the last two cycles for gold, like in 2007 and in 2001, I'm going to show you this right now. That's the NASDAQ right there, but we're going to show you. I'm going to put up HUI, which is the gold stocks, and what you can see is in 2007, this doesn't look like much, but they had a pretty vicious decline here. This was like 15% just a few days, and they took off here. Now, one reason the gold stocks crashed with the market then was because they had gone up with the market. But what I'm trying to say, for about a 6 to 9 month period, they were essentially the best performing asset when the Federal Reserve began to cut interest rates in August of 2007. Now, the Federal Reserve began to cut interest rates in January of 2001. And you can see the huge run that gold stocks had for the next 6-7 years, right? And in 2009, they started, the QE, and the gold stocks did well for a few years. Well, now I think that's the real key, that the Federal Reserve is at some point is going to shift, from raising rates to cutting rates. And I think that's when gold and gold stocks can really, really take off. So I don't know when that's going to happen. I would assume that if this year we see a big smash in the stock market, that shifts the Fed from hawkish to dovish. And then you can really see this take off. And I think one of the real win behind the sales would be, right now we're seeing this reaction in the dollar. And the dollar might continue to rally and kind of like, that risk off trade like happened in 2008. In the short term. But once the Fed moves to cutting rates, you got that combined with the U.S. is going to have a bigger deficit than all the Western European countries, than Canada, than Australia, than Asia, any almost country in the world, as the economy potentially turns into a recession. And that could really cause the dollar to decline along with decreasing interest rates. That's when I think gold can really take off. Now, to be honest with you, I don't know exactly when that's going to happen. Is that going to happen this summer? If the market, say, busts in the next few months, is that going to happen later in the year? That's what I think. But I think when that happens, when the Federal Reserve shifts from raising rates to cutting rates, that is when you will see a real influx of money into gold, and gold really take off. And by the way, just from a chartist standpoint, and gold is like coiled spring now. I've never seen, this is just the GLD. I'm going to take a 10-year chart, a gold chart like this, where you have essentially, after the bust in 2013, have nearly a 5-year trading range. And if you can break roughly this 1375 to 1400 area, this thing is just going to take off like crazy. Even in, I don't think the GLD goes back 20 years, so I'm going to have to just get a chart of gold. The GLD only goes back to 2000. But even in the late 90s, we did not see this. You can see, but similar, we did see a similar kind of base here, where in the late 90s for 3-4 years, gold essentially was in a range from about 350 to 250. And when it busted out, it went out like crazy. So that was only like a 4-year range. This is coming on 5 years. So when that occurs, I would expect that the gold stocks can really, really move and gold significantly higher. Again, look at that big base and then look at that huge, essentially 10-year run. I'm not saying we're going to run into 2028, but I could foresee something like this happening for at least 5 or 6 years after we break out of this base.
Well, I mean, I agree with you, but the thing about gold and gold stocks, I can just tell you, we're talking about this, and nobody cares. I mean, about this stuff about them anymore. You can't see this, but I can see the number of viewers that are live on this video. And as soon as we started talking about gold stocks, they just dropped and plunged. And it shows you no one cares about it. So as we, I don't want to keep you all day and so forth. So we've already been talking for almost 30 minutes. So as we wrap up, let me go ahead.
Oh, just like to talk about one stock as we wrapped up here.
Yeah, that's what I was going to ask you is, so I want to, what's one stock or one idea that you got now besides gold and gold stocks? Because no one wants to hear about it.
Well, I like to talk about a stock first.
Okay.
I think this is going to be the disaster stock of the next few years is going to be Facebook. And I've told you off air a few times that Facebook felt to me, a lot of people say like Tesla's a fraud. And Tesla uses shady accounting, and Elon Musk is a complete bullshitter, if you ask me. Don't get me wrong, right? But the company, to me, that felt most like Enron. And now I'm not saying it's a fraud or it's going to go to zero. But in terms of Enron, the story was too good to be true, right? Always awesome earnings every quarter, and they were doing shady things. But it's actually Facebook. Because now we know that Facebook was doing shady things. They're spying on you. They're taking your information and selling it to advertisers and selling it to things like Cambridge Analytica, to collect data on you and then to promote to you or to use you as a research monkey or something like that, right? So that model is now coming to an end. Facebook probably from regulatory agencies, governments is going to get cracked down on privacy, and they're probably going to have to self-regulate just so people don't get too pissed off at them. So that also using all that information, because remember, it's not just like when you fill out a form somewhere or someone has your credit score. Facebook knows everything about you, right? They know who you're dating. If you're posting all this, by the way, I don't post all my entire life on Facebook. I think you're an idiot if you do. But they know who you're dating, where you're eating for dinner, where you're traveling, what your likes are. If you're following certain political parties, what parties you like, what you don't like. They know everything about you, but they cannot monetize that information as much anymore due to, I think, this crackdown on privacy. And that means their margins, which are insane because they were doing all these shady things, are going to go to crap. So I think at some point, and I know you have a small short position on it, I'm actually going to recommend some puts today because they report earnings tomorrow. And I think that this is going to be a complete disaster going forward. And if I got to recommend one trade, and I'm actually going to do something unique, I'm not going to do a long. I'm going to do a short. This is a short that's done very well from you and me. We recommended this, both of us, when this thing was about, I think, 117 or so. It's already fallen to 114.72. This is the corporate grade A, corporate yield bond. And you can see it's already broke through its March low. It's actually back to the lowest level since about April of last year, so since a year ago. So if we're correct and that these grade A corporate bonds are really junk, that is going to have to be reflected in the price of these bonds at some point. And here's the other factor that goes into the top of that is, we talk about liquidity. Corporate bonds are different from, say, McDonald's. McDonald's bonds don't trade like McDonald's stock. And this thing owns all these. If there is a huge outflow of money out of this, they got to sell the bonds that they own. Well, guess what? There's no bid on a lot of those bonds. Like I said, it's not like a stock. So then all of a sudden those bonds can start gapping lower, and then that in turn leads to a snowball effect where this thing can start gapping lower as well, and it all kind of feeds himself. Look, that was also the problem in mortgage-backed securities, right? It was a dark market. It was an over-the-counter market. It wasn't liquid. So this would be, you could short it if you want. But remember, if you short, you got to pay the dividend. And this thing yields just over 3%. Or like I've put in some 2019 Januaries and 2020 January leap options as a way to play this. That would be my trade, to short this via options. I'm not going to give away the exact options I'm buying because that's something, for subscribers.
Well, everything that we talked about, and you talked about with the bonds and the corporate bonds and the long-term charts, this is a trade geared up to take advantage of all that and make type of situations. So thanks for talking with me and everyone else. And people should know to go to your website, addictedtoprofits.net. You got a couple updates there that are coming out too. So thanks, and we'll talk again soon.
Yeah, it was good to be here.